Hi, everyone. Welcome to the Timing Research Show for February 29th, 2016. Today we will be talking about the 127th weekly report from Timing Research. If you haven't had a chance to take a look at this yet, just go to TimingResearch.com/reports, and you can download this or any past report there. My name is David Kosmeter. I'm the creator of Timing Research, and today I have Matt Buckley hosting again, so I'm going to go ahead and turn it over to him.
Awesome, Dave. Thanks for having me back again to host, and also looks like we have a great panel scheduled this afternoon. So very honored to be amongst some pretty big 500-pound heads. As David said, my name is Matthew Buckley. You can call me Whiz going forward if you want. My parents actually did love me. That is my God-given name, but I flew the FA-18 Hornet for the United States Navy for about 15 years, and then after that, I went from the cockpit to the trading pit. I was a managing director of strategy for Peak 6 Investments up in the Chicago Board of Trade up there in Chicago, the CEO of the Options News Network. And then, as we were just joking about before we got started here, Chicago winners were better left for somebody other than me. So I moved down here to Boca Raton, Florida, and started Top Gun Options about 6 years ago. So having an absolute blast. We got John Thomas from Mad Hedge Fund Trader, Dean Jenkins from Follow Me Trades, James Ramelli from Alpha Shark, and Kurt Capra from Pristine. So, gents, let's go in that order. And if you could, just give us kind of that executive summary about who you are, what you do, and what's putting a smile on your face right now. So, John, why don't we start with yourself?
Well, I'm another military pilot, except I flew C-130s because at 6'4", they wouldn't let me into fighter planes. They told me if I ever tried to eject, my head would come off. So I went to Russia and flew all their fighters instead. So I flew the MiG-25, the MiG-29, and the Sukhoi. I've been running the Mad Hedge Fund Trader Trade Alert Service for the past 9 years. We have a following of about 125,000 people in 130 countries, and I've been playing at this game for almost 50 years now, and love every day of it.
Oh, that's hey, John. Thanks, man. Thanks for your service. That's pretty cool, and I'll bet you flying.
Semper Fi.
Oh, okay. So you're a devil dog. Oh, that's even better, man. So we have I got a fellow naval aviator on here, man. So that's great. So good to be amongst a brother.
And I'm talking to a squid.
Yeah, that's exactly right. We got a devil dog and a squid on here. So here comes the jokes. Okay, Dean, how about yourself?
Yeah, so I'm Dean Jenkins of Follow Me Trades, and I was in the Navy as well. I was flying guided missile destroyers and standing plane guard back off the fantail of the carrier while you were launching and recovering.
So we got a tin can guy with us too, man. This is great.
Yeah. So again, Dean Jenkins, Follow Me Trades, and I am a stock picker. That's that's what I love doing is looking at charts, and I use Elliott Wave, I use Dow Theory, art software from Traders Coach, and I just love analyzing charts and figuring out a trend and getting in on good trades. So I offer a stock picking subscription service to my audience. We do option plays on a lot of the trends we're into, real simple, buying puts, buying calls. And I'm an educator as well. I give one-on-one coaching, and I offer some classes on analyzing charts and trading options.
Awesome, Dean. Looking forward to hearing from you on the report and what's going on in this market. James, over to you, my friend.
All right, thank you, Matt. My name is James Ramelli of Alpha Shark Trading, based here out of Chicago. I do have to deal with the Chicago winters, but that's okay. I am relatively fond of this city. Here at Alpha Shark, our main focus is equities and equity options. So what I spend the majority of my day doing is staring at the equity options order flow that comes across the tape using a variety of equity options scanners. And what I'm trying to find by looking at all this order flow are the biggest, most unusual trades that are coming from the biggest traders, hedge fund managers, and institutional traders in the world. And what we're trying to do is see where all the big smart money is pressing longs and shorts using equity options in any given day. And and we catch a whole lot of what we would call insider trading, very suspicious options trades that happen ahead of announcements or news. So this is something that we pay a lot of attention to. We do have a suite of educational products and software products that are all aimed at helping retail traders understand the equity options markets better, particularly the idea of unusual options activity and following hedge fund order flows. So that's our main game and what we tend to focus on, and I'm happy to be here today.
Awesome, James. I might have to talk to you offline. Years ago, maybe you can confirm real quick. I want to ask who was it? Heinz Ketchup was bought by, what was it, 3G Capital and Warren Buffett or something like that. And Heinz options traded like one call every leap year. I mean, there was just no activity in it. Like 2 days before, there was like 80,000 calls bought. I mean, okay, duh, somebody's going to notice that. And I had heard that it got tracked back to the People's Liberation Army, that the Chinese government was actually, starting to trade, because they're hacked in everything. They're hacked in the Goldman Sachs. They know all these deals are going on. Did you ever hear that story?
Yeah, that's actually, I know the exact trade that you're talking about. I actually bought some of the same call options and sold them for like a 20-cent or a 20-cent profit before the announcement was made. They actually found out that the people behind that had hacked into Reuters database and had taken every single news wire that had been embargoed throughout the course of a year and used it to trade options. In that particular options trade, like you said, Kraft never saw any order flow. Yeah. And in the course of like a week, we tracked 60,000 out of the money calls being bought, and they didn't even try to hide it. They were buying these 20,000 lots at a time.
Yeah.
And by the end of the day, after the announcement was made that they were going to merge with that Kraft and Heinz were going to merge, that trader on the other side of that trade bagged up about $45 million in profits. And fortunately, even though I didn't really get the big end of it, a lot of the subscribers in our trading room stayed in the trade. And I mean, it was one of the most profitable and most obvious examples of unusual option activity in insider trading I've ever seen. People
That's
that
incredible.
bought like a 20 or 30 lot were clearing $150,000, $200,000 in profits in 3 days.
So that shows. I mean, that shows you, following unusual options activity can be very profitable if you don't know something. If you know something, you could be in a lot of trouble.
Right. That also happened just prior to 9/11. Somebody bought $200 million worth of American Airlines puts 2 days before 9/11. And the profits were all traced to a Swiss bank, and the money was never picked up.
I heard that as well, John. I used to, my first flight for American Airlines was scheduled for September 11th. Instead, I was flying combat air patrol over the Southwest United States. So, lost my job in American, and we called that the Bin Laden trade. That was in fact true. All right, well, we can drop anchor on some cool stuff here all day. Let's get to Kurt finally, and we got to get him in the conversation. Kurt, how about yourself, man? Let us know about you and what you do over there at Pristine.
Hey, thanks again. Good to be here. At Pristine, we pretty much focus on technicals. No real use of indicators or subjective type tools, and just following the footprints of money and human emotion. It works. Doesn't matter what you're trading, equities. I focus more on Forex. Same method applies there. So really anything you're looking to trade, you can use this method. We offer webinars every single week that anybody listening can come stop by, see what the way we look at things, and go from there. But we offer different services and educational courses like everybody else here too, I'm sure. But happy to be here once again and talking about the markets.
Awesome, thanks, Kurt. All right, let's get airborne with the first question there, guys. I know you all hopefully had an opportunity to review David's report that he sent out. Question one, and we'll just go in that order: John, Dean, James, and Kurt, and I'll chime in at the end. And answer this question. What developing events, technical or fundamental or, I don't know, seat of the pants, anything, what are you watching out for this trading week that might have a positive or negative impact on the S&P 500 and other U.S. markets, John?
Well, obviously, there's the non-farm payroll on Friday. I'm looking for a good number, close to 200,000. We should levitate until then. Maybe a good number on Friday gives us one more short covering rally. So my call on the week is that we'll be up, but not by much. This is going to be the second chance you get to sell in 2016. So I think we're going right back down to test the lows after that. But they're not going to be new lows. They're going to be higher lows. I think we're looking at 6 months of higher lows, higher highs. Lower highs and higher lows to make a wedge. The other big number, of course, is the oil inventories that come out on Wednesday. We're still in an oil-driven market, so that will be a big factor. And if we get another run towards $26, we're at 34 now, you want to be buying those USO calls. So it's this week, I'd say, sideways to up in a narrow range into the non-farm payroll, then a spike, then you sell the daylights out of it.
Okay. I couldn't agree more with just about all of that. Dean?
Yeah, so I think we're in a long-term bear market, and I'm projecting a pretty significant decline through the rest of this year, maybe into next year. But right now, I think this week, just a short-term forecast, higher for the week with a pretty low confidence on that, like a 55% confidence. We're in a bit of a little bear market rally. It's unstable. There is some planned reports coming out, like John said, and those will certainly make a difference. And it's strange the way the market is highly correlated, 90% correlated to the oil right now, which is not a historical relationship at all. So, higher oil prices don't make sense for higher equities across the broad market. But right now, that they are pretty well locked together. So I'm looking for probably some highs this week. We're in on a 60-minute S&P 500 futures contract. We're in a wave 5, and it's got a little ways to go, but I think the bear market will resume, in a few weeks, and we'll be heading back down.
I think you might have a lot of company there, Dean. Okay, James?
Yeah, I would agree that, the biggest thing that we're looking at this week in terms of a catalyst is the jobs number on Friday. If we take a look at what market makers are pricing into S&P 500 futures options in the minis this week, it's about 32 handles, and that's actually not that much given the amount of data that we have coming out this week. So it would actually appear to me that markets, at least options markets, are expecting a relatively muted move on the jobs number. I do agree with John that we could see a aggressive short covering rally if we do get a solid number. And I think it's kind of tough to see rallies like that and stay bearish. I mean, we've seen some aggressive low to high rips in the market, but the strongest rallies, the most aggressive rallies, happen in bear markets. They're driven by short covering and action like that. One of the things that always shapes my opinion is what I'm seeing in institutional order flow, and it is Monday. Normally we track about 25 to 30 large block trades in a day. It's 12, 15 here in Chicago, and our system has tracked 2 so far. So it would appear that institutional money isn't quite sure what they think about this week yet. A lot of the trading that we have seen has been kind of protective looking, but with all that being said, with that 30-point implied move that we have, or 32-point implied move that we have, it would put us in an upside target and downside target that seem almost ambiguous. They don't really seem to have much technical significance. So I think the market is not so sure yet, but with a good number, we probably do see a rip higher with a good opportunity to short, just like John said.
Okay. Sounds like we do have some smart people on here. Kurt, how about yourself?
Yeah, I got to mimic what the other guys have said as far as catalysts for the market this week. Jobs report, oil's been an obvious correlation to the market recently, so those are the things you kind of have to keep your eyes on. But you also want to watch support and resistance levels. For example, you got the S&P, which is hovering just above the 50-day moving average on the daily, but both the Nasdaq and the Russell are at or slightly below that mark. So I think that's going to be something to watch for this coming week as well, to see if the S&P is leading or if it's just got a little extra pep in the step or had and will give way and start to move lower. So those are some of the things I'll be keeping an eye on.
Okay. And I'm agreeing with just about everybody here. Let me share my screen real quick. I think that's how we do it right
So
there.
let me ask the next question. Since we pretty much all agree on everything, what's the surprise here? What's the black swan? What's the out of the blue shocker that sends us all, to running to cover our shorts and go long?
It's a great question. I've been using and hopefully you guys can see my chart. I agree. I think it was Kurt just at the end there, or whoever was talking about this little kind of it. And John, you can appreciate this terminology. We're at stall speed right here. I told my traders, I said, if we zip through the 50-day with any airspeed, put your rally cap back on and just smoke the hopium. But if we hit this 50-day and just kind of stall, we're done, and we're hanging out. So I agree with you, John, saying, hey, we're going to kind of channel sideways into Friday's jobs number and also the crude oil inventory report. I think you noted because this is a crude-driven market. I love a year. This time last year, we were kind of going through the same oil dance as well. And it cracked me up, some of the talking heads on CNBC, I call it Comedy Central, but on CNBC, who were like, oh, low gas price, low oil, low gas, great for the economy. I'm like, I wanted to jump through the screen and strangle them. I'm like, how stupid are you? Go to Nebraska, go to Houston, go to Midland, Texas, go to Baton Rouge, look at all these places where one of the few places in America where you can have a $100,000 a year job with just a high school diploma is in the oil industry. These places are imploding. Your little $25 that you save this week by not filling up, the family truckster ain't going to put a dent in all the jobs that are being lost. Schlumberger, Halliburton, all these guys. Chesapeake was rumored to be going Chapter 11 about 2 weeks ago, and it's bad. So I agree with oil is going to be a big driver of this market, but also the jobs number. If we don't see a solid jobs number, I don't know if we're still in bizarro market or not. And I define bizarro market as good news is good news, bad news is good news, and awful news is great news. So if we get an awful jobs report, does the market say, you know what, that means the Fed's not going to raise rates in March? So I'm going to say we move sideways to a little bit up this week. If there's a 2 in front of this number, we're okay. If there's a 1 in front of this number, we might have a little bit of a problem to the downside. So okay, let's go. And so John, back to you for we'll hit question 2. I think you all kind of answered that already. Based on any technical or fundamental indicators you want to use, would you predict that we're going to be higher or lower from Monday? I think you said channel to up. Is that correct?
Yeah. Can you put your SPY chart back up there again? I want to point out something to the listeners which may be incredibly useful.
Okay.
Is that possible?
Yeah. 1 second. Let me.
What you have to adjust for in this market is the presence of high-frequency traders who just got a new ton of capital at the beginning of January. So they're a bigger influence than they have been in past years. And what this is doing is creating both false breakdowns on the downside and false breakouts on the upside. And what this does is it brings in a ton of extra short covering at tops and a ton of stop loss selling at bottoms. And if you're new to this market or if you're just learning, it's designed to freak you out, choke your, puke out your position, so they can then buy it, turn the market, run it back up a couple points, and take a profit. So you've got to watch this with your stop loss discipline. Don't get suckered in or out of positions by the high frequency traders. And this is a new element in the market, and it's getting worse year by year.
That's a great point.
Okay, let me mention something on energy also. In the last 5 years, or the last 18 months, we've lost 150,000 jobs in energy. It's gone from 10% of the GDP down to only 5%, so it's not big. However, energy has been 70% of total economic growth for the last 5 years. And that's basically going to zero in a very short period, which is why oil is having such a big impact on the market, even though it's a small part of the economy overall.
Okay, awesome, John. Thanks, Dean. What are you thinking towards the end of the week? Higher or lower?
Yeah, higher. I'm going to go ahead and share a chart here. Let me Google Hangouts here is an interesting piece.
Yeah, in the top left, there's like a green. If you run your
Yeah.
mouse to the left side of the screen, there's a green. There you go.
There we go. John asked a question. What would be a big catalyst that might kind of change all of our projections? And I was thinking to myself, well, a Hillary indictment might get things heated up.
Not going to happen.
Not going to happen. Sold.
I think you're right. But that would certainly light things up.
If you, Dean, if you, John, or I had even handled one just not even top secret, classified email incorrectly, the NCIS would have been at our door. We would have been arrested, or at least put and gone through an Article 32 hearing and lost our clearance immediately.
Yeah, kind of like
it's awful.
Kind of like.
Well, I'm even in a worse position because documents I have written for the Defense Department have been classified top secret, so I can't even mention what I've written.
Correct.
But let me ask you this question. Is a black female attorney general really going to indict Hillary Clinton in an election year?
Sold.
Even if she had evidence, I don't think she'd do anything. She wouldn't want to interfere with the election process.
Correct.
So, conservatives hanging on this, to bail them out,
No.
not going to happen.
Well, the only hope, and I have a couple buddies in the ring there up north, and they're like, the FBI is furious. I mean, they might have a revolution. I mean, the director of the FBI is supposed to be pretty independent, and these career guys are furious. So you might have, I don't know what they can do, but I'm just hearing if it doesn't happen, you're going to lose half the government of good people, which we're screwed. So,
yeah,
but sorry, Dean, go ahead.
I've been angry ever since James.
Panama, top expat destination. So here, back to the charts, man. So this is the E-mini on a 60-minute chart. I like this for projecting, like a current week. And I like Elliott wave. Some people kind of roll their eyes and go, no two Elliotticians can agree on a wave count. But I use a real simple method, and my mentor, me, my students, we can all land on the same wave count here. So, we had a wave 3 up earlier, really nice, kind of a perfect wave 4 down into the correct Fibonacci zone. And so now we've got an extension target that takes us up 1974 to 2029. And, if you just use Dow theory and say, is this current leg, is this current trend underway, we got a higher high, higher low, higher high, higher low. And so we expect a higher high up into that target zone by the end of the week. And, the histogram showing, bullish momentum with each up move. So, that's what the technicals are telling me with my analysis. It's been pretty accurate. Again, I think we're in a longer term bear market, so this rally will end and we'll go down, I think, make some new lows for the year. And that's where I'm really making money. We've done really, really well on some large cap puts. Talking about energy, oil, it's been in a 18-month downtrend, down market. Started at 140, went down. Now it's down in the low 30s. Right. At some point, that's going to recover in just a typical corrective wave back up. It's going to take us up to $60-70 a barrel, and it hasn't proven that that's going to happen yet, but it will at some point recover, probably this year. And when it does, there's going to be some amazing trades. If you've been watching gold, we were watching gold really close, and it put in a bottom just like oil. And when it broke out, it was dramatic. And then the smaller caps that are associated with gold, the smaller mining companies, we were in like 40% profit in 2 weeks and still in the positions. And I think some of the energy companies you're gonna have those same kind of trades coming up when oil proves that its recovery is underway. So looking forward to that.
Okay, awesome. James, what are you thinking towards the end of the week?
Yeah, I think, even though I am bearish the market in general, I think we probably see a quiet grind higher this week into the jobs number. With that implied move that I was talking about earlier, like I said, it would put us around the 1980, excuse me, around the 1980 region in S&P futures by the end of the week, which is kind of no man's land. We really need to break above 1990 or 2000, somewhere in between there, with some conviction, I think, before I can really say that I'm ready to look for long positions again. And we're not really implying that we're going to get there after the jobs number on Friday, we're towards the tail end of the earnings cycle now. There isn't really very many catalysts until we get back into the earnings cycle. So I think once we start to see that lack of catalysts and no significant breakout by the end of the week, that sellers will start to step back into this market. And one of the things that is interesting here is that anyone who wants to kind of express that view with options can still do so relatively cheaply. Despite all the volatility that we've had, the VIX is still under a 20, which is actually below the long-run historical average. People look at that, VIX trading around a 20 and think that options might be kind of expensive right now, but that's not the case at all.
That's a great point, James. Yeah, and we might talk about the VIX here in a little bit. Okay, Kurt, over to you.
So what's the question again? With all this other conversation, I got.
It's over towards the end. What do you think the market's going to open higher, lower? Not open, close. What do you think we do by the end of the week?
I think that we just got to go with the hourly trend for now. With the disconnection between the S&P, the Nasdaq, and the relation to the 50-day, I think there's so many variables going on that, in my opinion, the safest, the most trustworthy source would be following that 60-minute trend, which has been moving higher here since going back to last week. And unless there are key support levels broken there, I think we just continue to slowly meander our way higher. So around the 1900 level on the S&P would be I think a major level of support that if broken, results in us moving down, but I can't say I see that happening here in the coming week.
Mm-hmm. Okay. Great. So that knocks out question number 2. I think question number 3, you guys kind of answered as we went along with it about how how confident you are of your question number 2. Here's what I want to switch to next, and we'll go around the room here because I love, and I know our David's listeners like one of the reasons they come here is to see what would potentially be a good trade, or what are you looking at right now. So let's go around the room, starting with John. What's a nice, sweet trade you either have on right now or you'd be looking to place right now in today's market?
Well, for the short term, you basically want to be buying every dip in gold. We've been long since the beginning of the year when we got the data on Q4 global gold production showing that it declined for the first time in history and will continue to decline for 4 more years. Less supply means more demand, so that's a no-brainer. One of the seminal trades of the year is setting up in April when Apple reports its Q1 results, which will be terrible. People are hoping for a good capitulation sell-off there into the high 80s. Then you want to buy Apple through calls or call spreads for the ramp up to the iPhone 7 launch. And then, of course, oil is going to be, we're calling oil the top performing sector of 2016. At some point, the final bottom will be in, and you'll get multiple performance on a lot of oil plays, just in the outrights, like oil stocks, and of course, options on USO. You should be able to get tenfold returns on those, especially if you're buying the longer dated call options or call spreads. So that would be 3 big areas. Also in the stocks in general, if the SPY bottoms this year, then technology stocks are going to take off like a scalded cat because they'll be down 30, 40, 50% from their highs. So those are 4 sectors that we're really keeping a close watch on.
John, when do you think we bottom in oil? What are you all predicting?
I've been covering oil for 45 years. It's uncallable. Anyone who says they know the bottom in oil is just making it up. I can tell you, I've been in production myself for 5 years. Nobody can tell you where the bottom in oil is. Like all commodities, it has no income, doesn't pay interest or dividend, costs money to store, and that creates a whole set of different pricing dynamics different from stocks and bonds. So, you know, I think 26 is cheap. If I'm wrong, it'll go to 22 and then bounce quickly. You know, down in the mid-20s, the risk-reward is just so overwhelmingly in your favor, and the upsides are so enormous, you got to start putting your toe in there, and that's what we've done. We've already been long oil once this year and kicked it out for a double on the options. We bought the USO $8 calls, and you know, when oil was at 26 last time, and just got an almost immediate double on those.
Well, I think, John, you nailed it. It's you know, you're right. Oil doesn't have a CEO. It doesn't have earnings, dividend. But what it does have is a den of thieves. It's got a big group of people called OPEC who sit around a big table and all smile pretty for a picture and then lie. I mean, they carry those scimitars with them for a reason, because when they turn around, they stab each other in the back. So, you know, what's your take on Iran? You know, Iran, OPEC's like, hey, literally oil's moving. Hey, a Saudi Arabian minister in Houston said this today. Oil goes this way, the market flies with it. I mean, we're at the whim of literally comments out of members of OPEC. But what do you think the Iranian situation does to oil here? Because they've already said we're not stuck at this party. You know, we're not going to.
I've been writing in my letter for 5 years that if Iran gave up its nukes and rejoined the global economy, oil would drop by half, and that happened. And what I missed was the second drop by half. You know, it went from 100 to 50. I missed the 50 to 25 move. So, you know, we didn't go long, but we didn't go short either. So I think they're trying to be good guys. I think they're trying to participate. They're placing big orders for airplanes with Western Europe. They moved all their nuclear fissile material to Russia. Russia doesn't want them to have nuclear weapons. So I think Iran has basically permanently removed a $50 risk premium from oil. And from here, all is left is for them to ramp up their production from 500 million barrels a day to at least 2 million. And the geology there says if they had modern technology, they could produce 10 million barrels a day. And this is on top of Iraq moving from near zero to 10 million barrels a day also. So, you know, in a very short period, you basically have 2 new Saudi Arabias joining the global oil market, and that's why we've got oil at you know, $20, $26, $30.
Yeah, the Iranian situation, it was pretty interesting. You know, you mentioned them buying aircraft. I'm like, you know, for lifting the sanctions, you would have thought at least they would have bought a Boeing product, but, you know, buying the French, buying some Airbus.
Well, we have not lifted our trade sanctions yet. They are still in force. Only Congress can lift those sanctions, and you don't count on a Republican Congress lifting those sanctions anytime soon. You know, it may happen with a Democratic Congress. In the meantime, they're only allowed to trade with Europe and China. They're legally, Americans cannot trade with Iran yet until our sanctions are lifted.
Good point. Excellent point. Dean, give us a good trade, man, something we can sink our teeth into. What are you following and have on right now, or what are you looking to put on?
Yeah, can you see my screen now?
You bet.
Yeah, so here's one we're in that's just awesome. This is a gold mining stock, MUX, McEwen Mining, and we caught it down here at $1.25, right? It's up, you know, it's a low price stock, but it trades at really nice volume. And so as gold broke out, you know, this chart really kind of matches the gold pattern, right? And as gold broke out, we caught this trade. Now we're just trailing our stop up, right? We're in like 40% profit, and it looks like, you know, it already crossed my early projected target. So so we're in that one. It's too late to get in that one, but wanted to show it for fun. So I think a good sector that's really starting to show some recovery here is non-gold mining. This is Vail. They're into iron ore, bauxite, nickel, stuff like that. And, you know, again, I'm an Elliott wave guy. We've had a wave 3 down. You know, the basic commodities have been beaten down for years. And I see this bottom getting put it in, you know, a consolidation, a little channel, and then this Dow theory where it starts to pull up, you know, higher highs, higher lows. And it's just broke out. We caught it at 278. And it's, you know, pull back a little bit, but our target's up here at between 478 and 645. And we think this is going to be a good one. This one trades at super high volume too. You know, 16 million shares already today. And So we think these mining stocks, this one is Vail, and another one that we're in right now is FCX, right? And it's a very similar trade, similar pattern. And then this one, Joy, this is a mining equipment company, and great entry. We just triggered this morning at 13.12. Got an initial stop 9.39 and a target 22.35. So if we're right, we're going to nearly double our money. And we're trading this one with a call option contract. They have a nice option market on this one, so you can limit your risk, get that out 6 months out in time, and this one ought to be a great winner. With pretty low, you don't have to put a ton of money on the line, especially with options here to get a super nice return. So gold. John said buying the dips. I think so. If you look at the weekly chart on gold, man, it's got a long ways to go back up. It's in its recovery now, and particularly if we're right about the bear market, there's a pretty historical reverse correlation between equities and gold, and the technicals on the chart match that. So there should be some great gold trades, throughout this year and the next. And again, the mining sector, I've showed a couple here that pretty exciting. So we're in these, man. We're long.
Yeah, if I could throw something in, all of these mining plays are China plays, which is all saying that there's going to be a China recovery. And all these charts for the commodity space, they're all the same. They're all showing an inverse head and shoulders bottom for all of them. The only one of these I wouldn't touch is Joy, because they're mostly exposed to coal, and I don't think coal is ever going to recover.
Yeah, I pay attention to news and to fundamentals, but I make my decision on technicals, right? And the technicals are good, so I'm going with it. It's worked real well for me. But
yeah, it's tough.
And it can just be a short covering rally, and I'll take that, right?
True.
You can get a double on a short covering rally, especially on a beat up stock.
Yeah.
You got to stick to your discipline.
Yeah.
Yep. Those short covering rallies, man, they get some airspeed on them, and you can enjoy the hell out of it. Get out of them. Don't get greedy. James, how about you? What are you looking at over there at Alpha Shark? What do you like?
Yeah, so when we are focusing on institutional equity options order flow, in days and weeks and last week was a very quiet week as well for order flow, when they're not coming in and trading, we kind of have to look for different opportunities because they're not pointing us to where they're pushing their large amounts of capital, in the short term. So what I look for is catalyst-driven plays that are kind of agnostic to the moves in the broader market, because I think it's very difficult to try and swing trade the broader market or some of the more macro types of plays out there. So what we look at is opportunities to trade stocks ahead of earnings when there's established trends. And this week, Dollar Tree reports earnings. They actually report earnings tomorrow morning. And I'm thinking I'm probably going to be looking at call spreads into the close today. Retail names have been just crushing it in the tail end of this cycle. If you take a look at the XRT and some of the component stocks in retail, just a completely different technical picture from almost any other stocks on the market right now. Dollar Tree rarely sells off on earnings. In the past 3 years, it's only sold off 2 times on earnings. It's a name that traders like to buy on earnings. And I think technically speaking, it looks pretty strong here. From what we can tell, money flow has been positive into the name going into earnings. There's no weeklies. There's March options, so I think there might be a decent opportunity here to get long Dollar Tree ahead of earnings with a really strong historical record, solid technical picture, and good performance out of the sector this cycle.
Awesome. Sounds good. Kurt?
Well, like I said earlier, I've been more focused on Forex lately. I like U.S. dollar, Canadian dollar for a long trade down here. It's been kind of just hanging out in this support level. So it's not quite there yet, but it's acting like it's trying to carve out a bottom here, and with a little bit of strength, I think it becomes a nice trade for it. Not anything big, not any multi-week type trade, but I think it can definitely offer a nice recovery after falling hard. It's also, in a sense, an oil trade as well, if you think about the tie that the Canadian dollar has to oil, and so that's where I'm looking. I mean, you could also say, and kind of piggybacking on what John was saying, oil could get a bounce here. It certainly is acting like it's trying to carve out a bottom, maybe not the bottom, but I would agree in that oil could look to push up in the coming days and weeks here to come. So that would be another area to watch.
Awesome. Okay. I'm actually, so on Mondays, we do our weekly option service here at Top Gun Options at 1 o'clock, but obviously I'm doing this. We've done iron condors, weekly iron condors on Apple for the past month and a half after it's, it kind of came down with the overall market there, but it's been holding on to the mid-90s well. Kind of found some institutional support here, in my opinion. And John, I think you mentioned at the top of the show Apple earnings, and yeah, I think they're going to be disastrous eventually. And earnings to me is like a face slap. Not that I'm used to getting slapped in the face anymore, but it's before that face slap comes. It's before something big happens. These stocks tend to channel, and I just sent this out to my subscribers a little while ago. Here, we're going to do an iron condor on Apple for the week. Love weekly options. I have 125 contracts. Let me go ahead and see if I can get the preview here. See if I can pull up the metrics of the trade. No, doesn't do it. Give me 1 second. So my strategic mindset is the same as it has been for the past couple weeks with Apple. It's channeling. It's waiting for an event. The whole FBI thing was stupid. It cracks me up. They listen to China, what the Chinese tell them to do about security and privacy, but they're not going to listen to our FBI or prevent potential terrorist attacks. So here are the metrics on this trade, Iron Condor and Apple. 95.5, 95 bull put spread. That's kind of where institutional support has been seen for the past month-ish on Apple. And then selling the top, selling a bear call spread, 125 contracts, 99.5, 100 call. Why 125 contracts? Well, here at TGO, the model portfolio that I manage, it's based on a $100,000 model portfolio, and one of my SOPs or standard operating procedures or rules of engagement, if you will, is I don't want to risk more than 5% on any one trade in my model portfolio. Why? Because that's me. You could be 2.5, you could be 10, you could be 100%. I don't care. I don't give financial advice. That's just me. I want to live to fight another day. So our max potential loss in this trade is $4,200. Max potential gain is about $2,000, and using at the money volatility, there's a 56-ish% prob of that, and a 59% probability of at least breaking even of the football going between these uprights. Love the iron condors. Why? Because even Charlie Brown isn't unlucky enough to have this football go mid-flight and break in half. You can't lose on both trades there. So put that one in, and we're going to put that one down range. So that's a trade that I am looking at right there. And we've had 4 for 4 so far year to date on winning trades on the Iron Condor with Apple. So that's looking pretty good. Okay, let's go ahead and then we'll wrap up. We'll get one last question around the room.
Matt. Actually, John suggested the topic for the question 4 of the week on the survey.
Let me pull it up.
Recession. Okay. So I think if you guys want to take a minute and talk about that as well.
Yeah, you bet. Let's do that then. Thanks, David. Let me pull up number 4 here. Oh, good. Yeah. Great question. So let's go top to bottom and start there with John. Do you think the United States economy will be in a recession before the end of 2016? I love it.
Absolutely not. It's just nowhere in any of the numbers, and there's never been a recession in history caused by low oil prices, low interest rates, and weak foreign economies. The only causes of recessions in the past 70 years have been high oil price spikes and interest rate spikes. And right now they're headed the opposite direction. I think some of the negativity you're hearing about the economy is coming from the election. $8 billion is being spent to convince you that everything is terrible right now, so you'll demand a management change. It's just nowhere in the numbers anywhere. We have GDP at an all-time high, earnings at an all-time high, and rising. Just not what recessions are made out of.
Okay.
And with that, I'll cede the floor.
I will give back the time to the gentleman from Indiana. Dean, what do you think? Recession 2016?
No, I don't think so. I agree with all the points that John made, and Warren Buffett just released the Berkshire Hathaway annual report, and he said basically the same thing. He said it's overblown, all this negative talk from politicians who need a boogeyman, for them to solve. It's overblown. The economy's as strong as he's ever seen it, and all the signs are there, right? And I think the stock market will correct, but that's not going to cause a recession, right?
So you're a no as well, Dean?
I'm a no for the recession this year.
Okay, James.
Yeah, I think I would agree with Dean exactly there. I think the stock market is going to pull back. It is overbought. Stocks have rallied for reasons not necessarily related to fundamental economic strength. But with that being said, there is still growth in the economy. We're still seeing good positive fundamental macro data. So I don't think that we're in an area where we're going to get a recession. And I also agree that correction in the stock market, even if we see a 10-15% correction, that's not going to send us into recession territory. It's really easy to make the argument for a recession. I mean, the fundamentals in the level of U.S. debt is staggering, but at the same time, I mean, I don't think we're going to be getting the straw that breaks the camel's back anytime soon.
Interesting. Okay, Kurt.
I'm going to have to agree with these other guys here. I don't see it coming. Not this year. I mean, who knows what happens a year from now? But it's just not. It's not there on the horizon at this time. The technicals are damaged from an uptrend point of view. Weekly charts are more sideways here now. So we could correct a little bit. And last time I was on the show, I was saying the S&P might even break 1,800 in a relatively short time, but we held that prior low, and it's taking on more of a W bottom type look, and even put in a higher low and now a higher high. So it's actually looking like it's trying to creep its way back up towards the 2,000 level. So from a technical point of view, and that is, in my opinion, what'll be the telling piece to the puzzle. Because as we know, numbers get fudged, and we're told what media wants us to hear, but the proof's in the pudding there, so to speak. And so again, I don't see the recession coming, but from a technical point of view, the S&P may be headed back up towards that 2,000 level, but the caveat would be the Russell and the Qs getting a little stronger here, starting to see a little more strength there, and not the S&P doing all of the back-breaking work.
Mm-hmm. The good thing about being the moderator and going last is I can say something like this: you're all completely wrong. So, the Dallas Fed came out today and said we are in a recession, literally. I absolutely think we're currently in a recession. Everything from durable goods to business inventory. I work in an Amazon fulfillment company as well. I do consulting down here in Miami. It is an absolute, and I do speaking. I speak with a company called Afterburner, and we go in and we do keynotes and consulting with companies. Past couple weeks, I worked with Office Depot here in Boca Raton, and then I was up in Annapolis working with MGIC, the Mortgage Guarantee Insurance Corporation. So I don't trade in any names that I work with, just in full interest of disclosure. But I can tell you it sucks out there. There's not one business that I do consulting with year to date that is projecting anything other than cats and dogs living together, mass hysteria. So I'm going to break from the pack. I'm going to break formation and go. We are going to see a recession this year. We're already in one. And remember that data, the government doesn't wake up one day and says, hey, by the way, we're in a recession starting today. It comes after time. 6-8 months later, they go, oh yeah, we've been in recession since 8 months ago, type of thing. So if we're not in one, we're pretty damn close. So I'm going to break from the herd. I'm going to say yes for 2016 because I know we have to have a little bit of controversy today. So
well,
all right,
I'm going to make a couple points on this. First of all, you have a zero hedge article up there. They've been bearish for the entire 6-year bull market. Second, Dallas is probably in a recession. That's exactly what you would expect the Dallas Fed to say because of the collapse of the energy industry. The San Francisco Fed is saying the economy is booming. And right now, I'll go with San Francisco on this.
Well, San Francisco is booming. I mean, to live in a tent in San Francisco, it's $350,000.
Yeah, at least.
Yeah. So the tech. I think there's two economies, John. There's a manufacturing economy. You look at Caterpillar. You look at our stuff, our Tonka toys, and our stuff that does stuff, ships. The BDI stuff like that. But the tech economy is booming. But sitting here looking at my Samsung, it can do great things. I can't eat it. I can't live in it. I can't fly on it. I can't drive on it. Yeah. So the 12 little Fed heads, all are reporting ups and downs. I think Atlanta said things are sucking, but yeah, you're right. You look at a San Fran, but I'm going to stick to my guns. I'm going to say I think things are going to get worse before they get better, especially if we have who I don't think we want to have in the White House. I might be moving to Brazil. Okay.
Hey, I'll agree with one thing you said.
Just one thing? That's
Matt,
it?
Yeah. So just the point you made earlier about your approach to risk management, man. I emphasize that a lot too. I believe in that. We only put 2% on the line for 2% of the account on the line for trades.
Oh, cool.
But that having good solid risk management, a strategy and following it, for me that's what's maintained profitability. Wins are great, but losses, if you can control the losses, you don't have to win that much to stay ahead of the game.
Yeah,
it is hard to come back from a 20% hit, It
correct.
Is really hard to come back.
Yeah, you can't play if you've lost all your money.
That's right.
There's no coming back from zero.
Exactly.
I'll agree with you on that one, right?
In a big house like Morgan Stanley, you're not defined by how much profit you make in a bull market, but how much you control losses in a down market.
That's exactly right. That's exactly right, folks. Listen to what John just said, and that's one of the reasons, at Top Gun Options, our kind of ethos is discipline, risk management equals superior execution. A fighter pilot, a trader, all of us on here, that I teach my folks at TGO is the first question we ask ourselves before we squeeze the trigger on any real capital is, how much can I lose? If you're asking yourself how much can I make in this trade as your first question, you're a complete idiot.
Wrong
because
question.
if you're not okay with what you can potentially lose, who the hell cares about what you can potentially make? Plan on losing it. It's funny because I just, and I think that was kind of beat into me, obviously, in the military a lot, is always looking around for, around the ship, somebody's trying to kill you, including you. And it's the same thing in the market. So, yeah, we really stick pretty hard to risk management. Okay, I'll tell you what, guys. Let's go around the room. Give us a quick wrap up, John, Dean, James, and Kurt, about where folks can find out more information about you and what you do, because I think we had a great time today, and you guys put out some great information. So, John, let us know where we can track you down and get some great intel from you.
Yeah, www.madhedgefundtrader.com. Go there, sign up for our funnel. You'll get our product for free for 30 days. And afterwards, give me a call and we can compare the flight characteristics of the F-18 versus the MiG-25.
Oh, MiG-25, I'd turn inside that thing all day. I would fill that thing full of bullets. MiG-29...
you've done it for real against a real MiG-25.
No, not a MiG-25, no. High and fast.
Can you beat Mach 2.5?
No.
That's what I did.
That's a little too fast for me, man. Things can go very wrong going that fast.
They can.
That's crazy. Yeah. Okay, cool. So, John, thanks for being with us. Dean, how about yourself?
Yeah. So hopefully I'm showing my website here. It's followmetrades.com.
Yep.
Again, our primary product is a stock picking service. We've been nailing it pretty well for years. Last year closed out total model portfolio of 100K at 28.63%. We're already at like 13% this year, first couple months in, and so it's going great. And people are interested. sign up. You can subscribe. You can just get a newsletter for free, or you can subscribe. And there's a 10-day money-back guarantee. You get a couple weeks of picks. You don't like it, money back. Get your money back. No hard feelings. So followmetrades.com.
Awesome, Dean. Thanks for joining us today, and again, thanks for your service as well. James, how about yourself?
All right, so the best way to learn more about what it is that we're doing here at AlphaShark is to go to our website, alphashark.com. We don't really offer free trials of our trading room, which is kind of the best place to learn everything about what it is that we do here. But if you guys send me an email to james@alphashark.com, let me know that you saw me speak or heard me speak in the Timing Research show, we would be happy to put together a little bit of a trial for the room or for any of our services or products that you might be interested in. On another note, if you just have any questions about anything that I talked about or just kind of want to chat options, feel free to shoot me an email as well. Again, james@alphashark.com.
Awesome. Thanks, James. Appreciate it. Thanks for coming on. And Kurt.
Absolutely. www.pristine.com. You can go there, and you'll see on the right-hand side a list of upcoming free workshops that we have. So that would be the first and best place to probably get to know us a little bit more and kind of see how we look at things. We offer webinars talking about the market or different specialties every single week. So www.pristine.com. You can register for as many as you want, and we'll talk about next steps from there.
All right, thanks, Kurt, and thanks for being on. And folks, obviously, you can go to TopGunOptions.com to check out what we do. We do weekly live trading 4 out of the 5 days of the week. We have a live trading room. We manage model portfolios that are $100,000 a piece. Send out text alerts and email alerts as well on any new or existing trades or anything like that. And we have an absolute blast doing it. And you don't have to be a military guy or gal to get the methodology that we do. But it was kind of took everything I learned flying fighters and applied it to trading, because at the end of the day, trading is a form of combat. Somebody's going to win and somebody's going to lose, and I don't like being on the wrong side of that trade ever. So TopGunOptions.com. So awesome, guys. Again, thanks for joining us today. David, I'll throw it back over to you, my friend. Thanks for having me as well, and thanks again for a great report and a great panel.
Yeah, thanks, guys. Great show. Sounds like you guys could have kept talking about all this stuff for the rest of the day if there was time for that. But just want to remind everyone watching to go to TimingResearch.com/reports to download this or any of the past reports there. Also go to TimingResearch.com/current survey next weekend to fill out, or this coming weekend to fill out the survey and have your opinions be part of the next report. And just want to thank my guests again, John Thomas of MadHedgeFundTrader.com. Thank you for being on the show for the first time.
Thanks for the invite.
And Dean Jenkins of FollowMeTrades.com. James Ramelli of AlphaShark.com. Kurt Capra of Pristine.com. Thanks, guys, for being on again. And, of course, Matt Buckley, TopGunOptions.com. Thank you for being on to moderate.
You bet.
Thanks, guys.
We'll see you.